What's happening, Hardscapers? This is episode 356 of the How to Hardscape podcast. We're talking about how you can start and grow your hardscaping business. And on today's episode, I take a snippet from a budgeting workshop that I did a few weeks ago. We've been doing these budgeting workshops to help out those that are not quite ready to jump into a software like the How to Hardscape headquarters software, which will help you budget, estimate job costs, time track, schedule, so much more features within that. But if you're just looking for a way to calculate your average hourly rate per employee, per equipment, per day, per hour, whatever that is, and think about what overhead recovery method to use, we created a spreadsheet for that. And now we're just running workshops to allow people to get access to the spreadsheet, get their own copy of the spreadsheet, and then also understand how to use it. So we do a small group setting workshop. This is one of those that we did, this recording here, broken up a little bit, so we did edit quite a bit out, but to at least give you an idea of the thought process of budgeting to create a profit and loss statement for your business that you're working towards, as opposed to letting your business just dictate what your profit and loss statement is going to be by the end of the year. So you're trying to work towards something and have a goal in your business to achieve, as well as what your numbers are telling you. And we talk about Greg Crabtree in this episode and his direct labor efficiency ratio and management labor efficiency ratio, and how that can help you create a salary cap in your business. We also talk about 4 different overhead recovery systems. That is labor rate, multiple overhead, single overhead, and dual overhead. And in this spreadsheet, you can see a breakdown of your numbers using the 4 methods and choose whichever one is best for your business. So you can actually compare average hourly rates for employees, for equipment, between the 4 different overhead recovery methods with this spreadsheet. So just a way to help out those wanting to learn more about their business, understand their business a little bit more, price accurately. Still comes down to accurate estimating, but also knowing what you should be pricing for yourself and your business. But I hope this does help you. If you are interested, there's going to be a link in the show notes with our workshops. We have one today if you're really wanting to sign up and get in before 7:30 p.m. Eastern Standard Time. You can sign up for that. Also, on the howtohardscape.com events page, we'll also have future workshops that are scheduled there. So you can always check out that page, and we'll leave those in the link in the show notes. Or you can always just send me a message at howtohardscape on Instagram or email contact@howtohardscape.com. But before we get into today's episode, we want to say thank you to our sponsors. Cycle CPA. If you're looking for bookkeeping, accounting, CFO services, reach out to Cycle CPA at cyclecpa.com. Let them know How to Hardscape sent you for money off their services there. And Knowledge Tree Consulting. George and Peter there are efficiency consultants in our industry, and I've had the privilege of having them both on one episode of the How to Hardscape podcast, and George multiple other times. And without further ado, let's get into today's episode. Next 3 fields here we have our working weeks budgeted per year, working days per week, and working hours per day. So this sets the duration of your year as you're going to work. So if you have snow that you don't do design build work during the snow season, you'll want to budget this accordingly. What I do in my business is I always carry forward last year's into this year's. So for example, last year I worked 36 weeks. I'm going to carry forward that number into this year for 36 weeks. That way, if I worked, say snow came earlier, I only got 34 weeks in this year, 2026, and I'm setting my budget for 2027, I'll carry forward that 34-week number into 2027. So I'm always lagging behind a year when it comes to this. Now, this is your total working hours per year once you've put in your working days per week and working hours per day. You do not want to overestimate this. If anything, you should underestimate it very slightly, but this does set how much you're going to be paying your employees, whether they're working in the field or not. So even if you take a week at the end of the year to clean up the shop before you lay people off or whatever, that should be included in this number. Once you have those 3 numbers in, you'll get your total working hours per year as a formula, so it'll automatically be updated. And then we get to total unbillable hours per year. So out of these hours,
Approximately how many of those are unbillable? So spending, like I said, a week at the end of the year to clean up the shop, put equipment away, whatever you need to do. If you do a whole week there, anything throughout the year that is not job specific. In our software, for some of our software users, we have job specific unbillable hours. That's the efficiency factor. So we factor that in when we're quoting a project. So that's things like drive time, because that's going to differ from project to project. That's things like breaks and lunch, things like that, that will differ very slightly from project to project. Whereas here we have unbillable hours, that's a accumulation of the entire season. And with that, you'll get your total production hours per year. And this is in the field producing. So also unbillable hours. If you knew that you had 5 rain days last year that you didn't work, and you had guys come in and they had to get their 3 hour minimum. Well, that's 3 times 5. So 3 hour minimum times 5 days last year. That's 15 hours. You'd want to add those 15 hours into this. Or maybe you still have them come in for a full day and they work at the shop to clean up whatever they need to. Once again, we get our total production hours for the year. So in the field producing work. And then your division sales goal for now, just put in your number from last year. Like, what was your sales from last year? Put that number in here. This is not that important right now. We're going to revisit this when we get to the profit tab. With that, we're going to move on to our cost of goods sold. You could call them direct costs, direct expenses, cost of goods sold, cost of sale. The problem with accounting terms is there's so many different terms that all mean the same thing. So as long as you know that cost of goods sold is the same as cost of sale, or is it the same as direct costs, or same as direct expenses, these are all things that are tied to specific projects that don't move forward with your business to the next project. For example, overhead. Overhead are office expenses or indirect expenses or indirect costs. That's all overhead. These are things that stay with the business. They don't stick on a project from project to project. So we'll talk about overhead soon, but for now, we're going to stick with cost of goods sold, and we'll have to budget our field labor, our equipment, our materials, and our subcontractors in this. And these are all tabs that are spread across this spreadsheet from side to side. So with this, we're going to start with adding some employees in here. Now, as an owner operator, you want to include yourself in here. Thing I see with onboarding so many people in our software and through when we first had the budget and estimate spreadsheet, if you're familiar with how to hardscape, a lot of people just figured their profit at the end of the year. That's what their salary was. That's what they took home as a business owner. But you and your business are completely separate. You're separate entities. You are an employee of your business. Whether you're a sole proprietorship, doing business as, or whatever it is in your business, you are an employee of your business. You want to pay yourself a salary. Now, for the purpose of this, whatever you put in here for your salary doesn't have to be what you're paying yourself, but it does need to be a fair market value. So think about what you do in the field, not what you do as a business owner doing like sales and doing emailing admin. If you do bookkeeping for yourself, bookkeeping, all those like admin office tasks, not producing labor tasks, we're going to do that in the overhead. We'll also add you here as an employee for those tasks. These are only if you're in the field. So if you're in the field, you would want to add yourself here. And you'd want to add a fair market salary or wait. In this case, that we're doing only hourly here. So this is an hourly wage. And then you can see your salary at the right here once you put your hourly in there. But what would it cost to replace you in the field? This is good for not only the health of your business, but if something was to happen to you in the field where, knock on wood, something happened to you, you couldn't work for 6 months, at least you've priced projects where you could subcontract these projects out and you could still be profitable for those 6 months that you're out of work, out of, doing physical labor. Or you could hire one, maybe two people to kind of fill in for your roles. Hopefully, fingers crossed, find an experienced person that's willing to kind of take on the roles. But at least you've kind of created that health in your business and that safety factor of if anything was to happen to you, all the projects that you've quoted, at least they factored in a fair market value for yourself. The way this works is just put in your employee name. I just put in employee A. If you don't have an employee, but you're planning to have an employee, employee A, employee B, whatever you want to call them. Position, whatever their position is, and their wages. What are you going to pay them? What do you currently pay them? These are base wages, so $22 an hour. And then you'll see that we have a formula here for the amount of hours. That's just based on our total working hours per year. So that's what you're going to pay them throughout the year, not the production hours, because this will include unbillable time. And once again, you can see that the hours are highlighted green here because this is a field that we can override. And this is just in case you have a part-time employee. So I can override this and say they're just going to be half the time, part-time. I put in 800 hours there. It redoes that. I'll add myself here as an owner operator. Once we've got our employees in there, we've changed if they're part-time or not. We're going to add a labor burden percentage. This accounts for payroll taxes. This accounts for insurance, vacation pay, bonuses, anything on top of that. These are like the hidden costs beyond just paying a base wage for employees. If you have an accountant, a bookkeeper, they should be able to calculate this number for you and have good data on this to be able to give you. They could also give you an hourly labor burden to also add on top of the base. So if you know that you pay $6 an hour for a $22 an hour employee in insurance, payroll taxes, and so on and so forth, their 22 would go to up to $28 an hour. Once we put that labor burden percentage in, we're going to get a field labor percentage of revenue just to show you what you're at in terms of percentage per revenue. This is going to be anywhere from typically 20 to 30% is what I've seen. That's totally depends on your business. If you're an owner operator still in the field, if you are part-time in the field, it's really going to vary, but 20 to 30% is typically what I see. But once again, that is using last year's, if you put in your last year's sales goal, and we're going to revisit that on the profit tab to put in this year's sales goal. So important to note. You also get your total field wages, your total field burden, and your total field payroll for this entire year or season, whatever you're doing, and a total number of field employees, field hours, field production hours, and unbillable hours. Now, equipment. This is cost of goods equipment. So this is production equipment that is producing you revenue in the field. If you have a shop loader, a piece of equipment that just stays at the shop and just loads up material, anything like that, that would be considered overhead equipment. So you can see on our overhead tab, we also have a space for equipment. Additionally, when you are quoting a job and you're using one of our overhead recovery methods, average hourly rate per employee, rates for equipment, for cost of goods, you're going to want to add these to every project. Overhead is recovered by, we'll get to that when we get to our overhead recovery, but you don't have to add those into every project. It's being recovered through your cost of goods. For example, multiple overhead recovery is recovering overhead from labor, equipment, materials, and subcontractors. Labor rate is only recovering through labor. So once again, we'll talk about that when we get to these, but it's important to note that any piece of equipment that you add here, to be able to recover this equipment's costs, it needs to be added to the project, which is why we have a rate per hour or a rate per day for each piece of equipment, because those need to be added to each project when you're quoting. On the other hand, if you want to put everything under overhead equipment, that's totally fine, but it's going to be billed to every single project. So whether or not you're using that equipment, it's going to be billed to it. So that's the difference between overhead equipment and cost of goods equipment. Cost of goods, you need to assign that equipment to the project. Overhead equipment, it's assigned to every single project, and it's recovering its costs through every single quote that you're sending out the door. Pros and cons to that are if you're a lean company and you're using a piece of equipment 75% of the time, that's great. You might be okay with just adding everything as overhead and recovering, billing it out no matter what type of project you have. If you're a company like mine, where we do design build work, we do lift and relay work, we do drainage work, those all come with different levels of equipment usage. For example, design build is going to use my equipment. Lift and relay is going to use barely any equipment, my compactor, basically. my truck, a trailer, right? But it's not going to use my skid steer or anything like that. So when I quote a lift and relay project and I have everything in overhead equipment, it's going to be pricing in my skid steer for that project. So just a way to think about what am I going to add in my cost of goods equipment and what am I going to add in my overhead equipment. Getting into this now, equipment that we add here, for me, it's anything over $500. That's just based on in Ontario, anything over $500 is considered a piece of equipment when it comes tax season and is a depreciating asset on our balance sheet. Anything under $500 is a 100% tax deductible in that calendar year. In terms of our taxes, anything under $500 is a tool. It's not a piece of equipment. Anything over $500 is a piece of equipment. You can do whatever you want. It really doesn't matter. The most important thing, though, is that whether it's a tool or a piece of equipment, it is being put somewhere in this spreadsheet. Tools are added as an overhead in the general expenses, which we'll get to, but equipment, you'll want to add cost of goods or overhead once again. So equipment, cost of replacement is, if it was to go down today, how much would you have to pay to replace it? Whether it's used, new, what would you have to pay today to replace it? In this case, this is fake numbers from whatever you see here, but 20,000, I'm assuming I'm buying used. So I put 20,000 in here because I'm going to replace my 1,500 truck with a $20,000 truck used. I then look at the market. How much mileage is a $20,000 1,500 series truck going to get me in terms of mileage? Maybe it's going to be easy numbers, 100,000 kilometers or miles, whatever you want to say. Well, how many years of use am I going to get out of that before I sell it? And I want to sell it ideally before it starts giving me issues. I don't necessarily want to hold on to it till 400,000 kilometers and have to deal with the mounting repair bills that are going to come with that. So that's an important thing to note. So $20,000 I paid. It's going to have 100,000 kilometers on it. I know I put 20,000 kilometers a year on my trucks personally. I know that. So after 7 years of use, that's going to be an extra 140,000 kilometers on it, plus the additional 100,000. That's 240,000 kilometers. Looking at the market today, with something with 240,000 kilometers, probably going to get $5,000 as a resale value. So that's how I go about this calculation. I'm just looking at cost of replacement goes down today. What am I going to have to pay for it? Not what your current vehicle equipment, if you were to sell it, what is it going to get back for you? What would it cost you today to replace it? Years of use, how many years of use are you going to get out of it? If you're buying new, 10 years of use, I'm going to put 20,000 kilometers on that truck. That's 200,000 kilometers. If I go to resell it, what am I going to get for it? That's how I go about these calculations. A dump trailer, I buy something for $10,000. I want it to last me 10 years. And then resale value, I don't expect to get much for a used dump trailer that's been through hell and back. So I put $1,000. I'll be happy to scrap it or whatever. You can also see here, like I've got my Hilti saw, my demo saw. I'm not even going to worry about trying to recover anything for that. It's peanuts. It's nothing. I'm going to use it for 5 years. I'm going to beat the crap out of it, and I don't expect to get anything back for it. Enclosed trailers, compactors, whatever you want to put here. This is also a good way to start to set goals in your business to buy equipment. So this could be goal for down payment skid steer. And you can say, you know what, a down payment for a skid steer, I want to have $25,000 and I want to have that in 3 years, zero resale value. And that's just a good way to set a goal that in 3 years, you want to have $25,000 for down payment on a skid steer. It's a good way to set a goal in your business to be able to get to a point where you have that $25,000 as opposed to it coming out of your profit or you as the owner having to have to reinvest into the business. Just another way to kind of use this tool to be able to set a goal in your business. Now, you don't want to get carried away with this and be like, I want 20 excavators and I want to be able to pay for them outright in 3 years. And you're just going to explode your expenses with this. So don't get too carried away with that. And having said that, when I put that in here, the goal, I should have actually put that in overhead because that needs to be charged out for every project and not added to specific projects. So what I just said there about goal setting, that's specifically when we get to the overhead equipment. Next thing that you'll need to do is expenses per year. This is fuel. You can see if you hover over some of these fields that especially have the black arrow in the top corner, right corner, you're going to get the explanation that I'm giving you here. Maintenance, repairs, fuel, insurance, licensing, and anything else. Cleaning, if you do that once a year or whatever, you'll want to add those all together and put them in here as an expense per year. Once we have our expenses per year, we get our cost per year for that piece of equipment. This is what we need to recover for the year, our total equipment cost per year, and our total equipment expenses anytime we assign that to a project. Now, if we have a utilization rate of 100%, we're using that every single day on every single project. You might as well put that in overhead, in my opinion. Now, take that for what you wish, but I prefer to just if it's used on every single thing, might as well treat it as overhead. That way, when I'm quoting a project, I don't have to add it to every single project. I don't have to go through and say, yeah, my 1500 truck, my 2500 truck, and my dump trailer and enclosed trailer is going to be on every single site every single time. And I need to assign that to every project that I'm quoting. You can just put it under overhead equipment and it's going to be charged out on every single project. You don't have to worry about it. Now, not everything is used 100% of the time. Say a skid steer. Oh, let's say a mini skid. Here we go. Maybe I use it half the time, 50% of the time. You'll notice when I change 100% to 50%, my cost per hour is going to double. It's going to go from $6.05 to $12.10. All that's doing is I'm saying that every other day I'm going to use it. So maybe on a 5-day project, on a 6-day project, easier numbers, I'm going to use it three of the days. So 3 of the days is going to be 12.10 if I do a 10-hour day, $121 per day times 3, that recovers this. But I'm not billing it out on every single day, especially if the next job I'm not going to be using it and so on and so forth. So all you're doing here is you are inflating the cost per hour of that equipment so that you're not charging it out on every single project. Because if you say this is one thing about adding equipment to your cost of goods sold, you do have to measure and make sure that you're hitting your utilization rate. Otherwise, if you say, yeah, I'm going to use it 100% of the time, and you bid a project that you don't use that piece of equipment, you're not going to hit that 100% utilization rate. You're going to miss your recovery on cost per hour, and that's going to throw you off your numbers in recovering everything and when you're quoting and everything like that. So you do want to track your utilization rate for the year and make sure you're trying to hit those numbers. Once again, another reason why I like adding equipment to overhead is being built out on every single project. I don't have to worry about utilization rate. Don't have to worry about did I add my equipment to this project when I sent out the quote to make sure I'm recovering it. Easiest way, overhead, equipment, everything goes there. That's for me. Like I said, I do operate a bit of a different business. Even though I do lift and relay, which has no equipment, and design build, which has all of my equipment, I still do that just because, in my opinion, lift and relay is very uncompetitive and I can afford to be a little bit more priced on those. That being said, when it comes to adding profit to that project, I might dial that back a bit. Once again, we'll talk about that on the profit tab. Okay, once we have our utilization rate in there, you'll have your cost per hour. This is what it costs you. This is not overhead recovery, and this is not profit on top of that. So this is just what it costs your business. You'll get your equipment percentage of revenue. Usually 10% is a pretty healthy one, 10 to 15%. That's like from light equipment to heavy equipment. But once again, this number is going to vary depending on what equipment we put in overhead versus what equipment we put into our cost of goods sold. This is why it's really important to know your business and know your numbers as opposed to listening to somebody else's numbers. Because when you hear somebody say that they were 35% profitable at the end of the year, was that net profit? Was that gross profit? If that was gross profit, was your equipment in overhead or was it in cost of goods? Because that's gonna change a whole lot of things. Does that include your owner's salary in there? Or are you paying your owner's salary as profit? That's gonna change even more so. So even like markup on percentage on materials. We're gonna get to that in our overhead recovery. Know your numbers, know where you're coming from. Don't worry about what other people are saying. Yes, I guess one concern is having all the equipment and overhead can make your lift and relay quotes higher than, yes, absolutely. If you add your equipment all into overhead, if you're not using it on certain projects, so lift and relay, it is going to increase your lift and relay costs maybe more than what the market is. Because if you have people in your market that don't have equipment, that don't have high overhead, and they're pricing lift and relay because they're just getting into the industry, they're likely going to be priced a lot lower than you. So that's the cost benefit analysis here when you're doing this. In my business, I'm very lean. I don't have a whole lot of equipment. That's why I don't mind putting everything in overhead equipment. As you get bigger and bigger and you have more and more equipment, you might have an excavator that sits there for most of the season, but you used it on 3 projects a year and it's very useful. That's a very good use case of we want to put that in cost of goods. We want to get our utilization rate dialed in on that. Maybe we use it a quarter of the year. You can see that that explodes our cost per hour so that when we do assign that equipment to a specific project, we're going to be recovering this much. But when we don't, 75% of the time we don't have it going out to that project, we won't be recovering anything on it. Think about the expenses that you did last year. Put a little bit higher number for equipment because as equipment gets older, maintenance costs are in repairs are going to increase. A lot of people ask me, okay, next year when I revisit my budget, do I change years of use down from 7 years to 6 years? No, it always stays at 7. Whatever you put in here, it always stays unless you feel like you're off on what you plan to use that piece of equipment for. All this is doing is it's giving you a ratio of your cost per year for something that you're going to hold on to for 7 years in this case. The formula for this is cost of replacement minus the resale value. You get that number and then you divide it by the years of use. And then you add the expenses per year to give you your cost per year. And then utilization rate is dependent on your cost per hour, however that is. One last thing that I'll go through with this equipment before we move on is if you finance, if you lease, if you plan to finance, if you plan to lease, you can put a cost of replacement of your lease or finance amount for the year. So if it's $1,000 a month, 12 months in a year, $12,000. Years of use, 1. Resale value, if you're leasing, maybe 0. You're not going to buy it back. Financing, you can add something here, but that's a little bit more complicated. I would just put it as 0 because if we have our years of use as 1, we would want to divide that by however many years we're going to be working. What this does, if I set it as 12,000 1 year, resale value of 0, it's going to recover my $1,000 a month if I have it assigned to projects at my utilization rate. If I'm using 100% of the time, it's assigned to every single project. I'm going to recover my $1,000 a month. It's good for cash flow. What it's not good for is at the end of its life, we're going to have a resale value. We're going to be able to get something back from that asset that we don't necessarily want to be charging our client for, right? $20,000 over 10 years, that's $2,000. You're charging your clients over the entire year, $2,000 more, spread out through the entire year, which is probably $10 a day or something like that. Not a whole lot, but that's something that you're going to be charging your client for if you don't have a resale value there. The good thing though is it's good for cash flow. You're going to be recovering what you need to be paying per month on that piece of equipment. $12,000 per year, $1,000 a month, you're going to be recovering. As soon as you add a resale value, you're not going to be recovering that full $12,000 a year, your full financing.
We want to take a break from today's episode to thank our sponsor, Cycle CPA. It's crucial to review your financial statements on a monthly basis so you can diagnose areas for improving your business's financial health early before they become significant issues. Too many contractors wait until the end of the year to review their financials as they file taxes, when it's often too late to take action to change the outcome. Cycle CPA not only handles bookkeeping and taxes, but they also ensure that you're armed with financial data on a monthly basis to make key business decisions. They offer benchmarking, cash flow forecasting, and assistance in developing targets for financial metrics. With their team of accountants specialized in the hardscape and landscape industry, they currently work with hundreds of companies in this field. Visit cyclecpa.com, and for $200 off, mention the How to Hardscape podcast. Now back to our episode.
Materials, I just did a bulk sum here. You can put last year's. This is just good to see a difference. When it comes to materials, I just think about how much I want to grow my business this year and be realistic. Don't be like, I'm going to 10x my business. And how are you going to 10x your business? Are you going to 10x your employees and hope for the best? Think about it realistically. If you're like, I'm a one crew business, I want to go to two crews this year, and that's realistic. You've got somebody in place that you're ready to put them in a leadership position to be the head of that next crew while you remain on another crew. That's realistic. Maybe you could almost double your business. You could be at 100%. In that case, you could look at your materials from last year, and if you plan to do the same thing, design, build, you could realistically say, if I did $65,000 in materials last year, I might be at, well, let's double that, 130,000. But maybe I don't want to, or 100, yeah, 130,000. That's 100%. So I've doubled my business, basically. If you're like, yeah, I'm going to double my crews, but I know that crew is going to be a little bit less efficient, will probably be like 110,000, something like that. That's where you come out like a realistic material budget for this, as opposed to just saying we're going to quadruple our business and not have a real goal in place of how you're going to do that. This gets a little bit more tricky when you're adding services. Say you're getting into swimming pools this year. That's going to be a bit different because now you want to be able to budget how much swimming pools you're going to do and so on and so forth. Well, I keep on coming back to this overhead recovery, but this is also why I like labor rate recovery, because we recover all of our overhead through labor. We don't recover any of our overhead through materials. So if you're going to use a labor rate recovery method, you don't have to worry about this number at all. If you're going to use multiple overhead, single overhead, or dual overhead, you do have to worry about this number. And you do want to make sure it's as accurate as you possibly can, track it through the year, and adjust as need be. Because as going back to my example, as a lift and relay design, build, drainage business, those are three really distinct businesses where the revenue per project of those, the percentages of labor, equipment, materials, and subcontractors are going to differ greatly. Lift and relay is about 10% materials. Design build for me is about 25% materials. That's a huge difference. Subcontractors for lift and relay are 0%. Subcontractors for design build are going to be 2 to 5% of my business for those projects. So this is where that labor rate recovery method, and we'll get to this. I keep on saying that, but it'll all click once we get to it. This is why I like labor rate recovery for my business, because I don't know at the beginning of the year how much design build work I'm going to do and how much lift and relay work I'm going to do. If I was going to be super accurate and know how much design build and lift and relay work I'm going to do at the beginning of the year, I would know how much materials I'm going to be using, how much they're going to cost me, and I'd be able to put in a very accurate number here. But for me, I'm not going to turn down lift and relay work. It's very profitable. I like it. So I'm not willing to try to hit a material sales goal just to say that I'm a full design build business. So again, it's going to differ from business to business of how you see this. And even if you are doing labor rate recovery, still put a number in here that you're thinking of, because it will play into factor for your total revenue, your profit and loss statement, as we create it here in your budget. So this is like pavers, plants, anything like that. This is like direct costs. So even like delivery, things like that. Whatever your supplier bills you for is what you would include in there. And with that, we're going to get a material percentage of revenue. Like I said, I'm somewhere between 20-25% for design build, about 7.5 to 10% for lift and relay for materials. And then the last thing is subcontractors. So same thing as design or as materials, a budgeted amount for what you plan on doing in terms of subcontractors. So gas, I did 2,500 last year. I'm looking at doing twice the amount of gas fire features this year. I'm going to be at 5,000. Going back to our material example, another reason why I like labor rate recovery, once again, specifically for my business, I don't know how much lift and relay versus design build I'm going to be doing in the year. So that way I don't know how many gas fire features we're actually going to be installing at the end of the year. Same thing if you're getting into swimming pools. Do you know how many swimming pools you're going to sell this year accurately? That might be a tricky one, and the subcontractors that come along with that. So for labor rate recovery method, you really only have to worry about equipment and field labor cost of goods. For doors, saws, and mowers, you do have to worry about materials and subcontractors. And that is our cost of goods sold. So overhead. Overhead is indirect costs, indirect expenses, whatever you want to call it. But we got labor, we got equipment, and we got general expenses. In our labor, this is yourself as the owner, even if you have accounted for yourself as in the field. Overhead, you're going to add yourself here as a salary. This is salary, this is not hourly. So this is where you would put salary. If you only know your hourly for your employee, just multiply it by the amount of hours that you're going to pay for them and put their salary in here. This is for anything in your business that you pay an employee for to do. Admin, part-time admin. If you have a salesperson, these are people that are not producing revenue in your business. Same thing, employee name, position, their salary. Great question. So what I do is for my cost of goods owner, I look at how many hours I spend in the field. And is that full time? Is that part time? How much would I have to pay somebody to be able to take over those hours? This is a bit easier because you would just set an hourly wage. Like what is somebody with your experience? What would you have to pay them to replace yourself? Or close enough to it. Like I say to everybody, I don't care what you pay yourself. It doesn't have to match this exactly. But what we're trying to do is we're trying to create a fair market value for what you're worth so that we can replace you someday in whatever roles and in tasks that you have. And you've already been charging like you are that company anyways. So when that time comes, you are already that company minus that hire. That's how I look at it. Same thing with the overhead expenses is for your salary. I add up all my hours in a month that I do sales, that I send emails, quotes. If you do your own bookkeeping, I break those down into tasks. I look at however many hours I spend in each one, and I look at how much it would cost me to outsource each of those. So like what's a part-time salesperson gonna cost you? What's a part-time or what's a bookkeeper cost you if you're still doing your bookkeeping, which I don't recommend. But design, you can add design in here. What's a part-time designer cost you? What's another task that I was saying there? Quotes, estimates. What would it cost to get somebody to be able to do that? Part-time too, as well. You don't want to go full-time. You don't want to be, I'm a full-time designer, I'm a full-time salesperson, I'm a full-time estimator, because then you're just going to explode everything. But what's a fair market value to be able to part-time replace each of those tasks based on the amount of hours that you're spending in each one? It's going to take a little bit of time to come at this. You can estimate this too. Like I said, this isn't necessarily what you're paying yourself or what you plan to pay yourself, but this is a good start to be able to plan to hire out these tasks. It's also a more accurate way to be able to come about your profit and loss and these two numbers here, which we'll get into too. That's how I go about that. I take a bit of time. Like I said, what you see here are fake numbers, but as owners of businesses, we take on a lot of risk. We do a lot of work. You should be paying yourself really well for that or working towards that, budgeting for it. And if you're not paying yourself that right now, that's totally fine. If you're reinvesting into the business, great, that's fine. But let's make a plan 3 to 5 years down the road where you're going to actually get to what you should be paying yourself as a fair market wage. This is a difficult industry. It's we work a lot and we take on a lot of risk. There's got to be a reward for that. Last thing that we'll add is labor burden percentage. These are for office employees. So this is going to be lower than what it would be for our field labor burden. Insurance is a lot less for office workers. Construction comes with a lot more insurance premiums and so on there. So this is going to be a bit less, especially if it's just you as the owner operator. You don't necessarily even have to worry too much about this. You can account for that in your salary or a labor burden percentage there. 15 to 20% for a part-time admin person is pretty good. And then with that, we've got our total overhead labor burden, and percentage of revenue there. So labor, we're done. Equipment, we kind of did this with cost of goods and kind of weighed the pros and cons of overhead versus cost of goods equipment. Once again, your goals would go in overhead equipment just so you can get that cost per year, no utilization rate. You don't have to you don't have to assign a goal equipment to a specific project to get that. It's just going to go on every single project. It's going to be recovered every single project. You see, I've got a computer here. This is a piece of equipment. It's over $500. Anything that you use in your business, camera equipment for marketing purposes, anything like that, all that goes in here. You see, I plan to use my $1,500 computer for 5 years, and I'm not going to get anything at the end of it. I've got no expenses with it. $300 a year is what I get with that. Once again, you don't want to double enter things. So if you added something in your cost of goods equipment, you don't want to enter it in your overhead equipment. It's one or the other, but fairly straightforward with this. Equipment name, cost of replacement, years of use, resale value, expenses per year, and is your cost per year. We get our overhead equipment percentage of revenue, and then we move on to general expenses. You'll have everything that I have here listed out. This is, to the best of my ability, everything that you would want to account for when it comes to general expenses. Accounting, advertising, bad debts, bank charges, cleaning, computers, contributions, anything that comes out, anything that you're able to write off in taxes should be accounted for here. If you have a home office, you're able to write off some of that rent or mortgage payment based on a percentage of the house or rooms that you're using. You should have that here as rent as well. That's in my opinion. Take it for what it's worth. But once again, if it's being able to be written off in taxes, it should be accounted for here. I justify that as one day we're going to have ideally, our own office space. And I want to be accounting for some sort of rent so that I'm charging for what I want to be tomorrow and not what I am currently today. That goes back to goal setting and Patrick's question there of setting a goal here. Once again, I want to be charging like the business that I want to be tomorrow and not currently what I am today. Same thing with setting a goal for your owner's salary. You can leave things as zero, especially things like bad debts, but things like cleaning, even if you don't plan or you don't have a cleaning expenses like cleaning trucks or anything like that, it doesn't hurt to add a little bit in there just in case. Dues and subscriptions, conferences, education and training, that can be for your employees too. So think of a cost that your employees, spend the first few days of the season just doing training. How much does that cost in terms of salaries, their wages or whatever, and put that in here. Benefit programs, gifts, liability insurance, building insurance, interest expense, legal fees. A lot of these are known amounts, but some of these are also budgeted amounts. So we've also have like, for example, advertising. That's going to be a budgeted amount. How much do you plan to spend per month? How many months are you doing advertising? I like to inflate this number a little bit. Any amount that I don't actually spend on advertising, I just put into things like donations to sponsoring an event or something like that. That's just how I look at it. So if I don't spend in this fake number here, $10,000 in a year, maybe I spent 8,000, I've got 2,000 remaining, I can sponsor a local event or something like that and use that money there. Utilities, uniforms, travel and entertainment, tools. Tools is where you take, in my situation, anything under $500. I just accumulate it in one, plop this number in here for what I'm going to be replacing this year. Hand tools, shovels, things like that. Just look at, how much did I buy last year? What am I going to need this year? Phone and internet, even if you're using your personal phone, put that in here. Taxes, you'd want to put in here. This just makes that whatever you set here as your goal in your business is after taxes have been paid for. So this is going to differ, and I highly recommend you talk to your accountant, bookkeeper, or accountant in this case, to ask them about this. Because I can't give you good advice about this. It really depends. Are you sole proprietor? Are you doing business as? Are you an S corp, C corp? There's all those different designations, company structures. So what are the taxes going to be is going to be based on that. Software, if you're using software, rent, yeah, we've gone through everything there. So then we go to our profit and loss tab. Now, if you haven't been able to fill out everything, you're going to do anything later, you won't have accurate numbers. So just take that into factor. Like you'll want to get your equipment in there and everything like that, all your field employees and stuff. Our profit and loss tab is going to be our net profit. So this is once you as the owner have been paid, labor, equipment, everything, all the bills have been paid, what's left over for the business. You'll get your net profit margin, so 5.8% there. And that's just based on your forecasted sales goal. So this was the number that we put in our budget info tab. At this point, we can override this. So at this point, 5.8% is not a strong net profit margin. I personally, anything over 10%, you're doing good. Anything under 10%, you'll want to relook at your numbers and make sure that you can get to 10% and beyond. Just because I look at it as the risk reward benefit of owning a business. We take on a lot of risk, and you know what doesn't take on a lot of risk is getting a good paying job and taking your money and investing it into the S&P 500 index fund that on average gets 8% over a 30-year period. And if you're making 5.8% on your business and it's got a whole lot of risk involved in terms of employees and lawsuits potential and all this, you'll want to be making more than 10%. So that's just me and how I look at it and how I try to set a goal for my business. So with that, you might look at your forecast and be like, you know what, I probably need to be closer to about 500,000 as opposed to 475,000 to be able to hit a net profit margin of 10.5%. And that's better. But is it realistic? You just want to go back into your numbers and make sure, are we going to hit that? What are we going to do to hit that? Are we going to become more efficient in the field? And once again, we'll talk about that when we get to these, which I keep teasing. And then we get our profit once again, a gross profit. Gross profit is revenue minus your direct costs. So your cost of goods sold. So revenue, your forecast, minus your cost of goods sold, and the percentage here. Net profit is once everything has been paid for, including owners. 10.5% there. So this is where you hear people like, I was 40% profitable last year. Okay. Don't listen to people because even a lot of people don't know what is the difference between gross and net profit. So even if you ask them, is that gross or is that net? They might not have an answer for you or might just say what they think it is. At least you know your numbers based on this and can dissect it, especially once we get to the overhead recovery here. And we're already a bit over. I'm okay with continuing. For anyone else, I'll be sending this video out anyways, but I understand if you do have to go. But we're just about at the end here. You do get a breakdown of your cost of goods sold. That's at the top of all these different tabs here in overhead, your percentage of revenue for each one. Same with overhead, your percentage of revenue, cost of goods, total percentage of revenue, total overhead expenses, percentage of revenue. These two numbers here, if you haven't read Greg Crabtree's Simple Numbers 2.0, I highly recommend it. They're great books. But these two numbers come from those two books. So we've got the direct labor efficiency ratio and we've got our management labor efficiency ratio. Direct labor tells you how efficient your field labor is, your revenue producing labor is. Greg Crabtree states that anything 2.0 or higher, you're likely to make a good net profit at the end of the year. So we're above that 2.0. So we're efficient with our field labor. Greg Crabtree's dealt with he's an accountant, and he's got some consulting service, and he does a lot of different sectors, not just our sector. And he's dealt with tons of businesses and researched tons of businesses. So this is based off of all of his research that if you're at 2.0 or higher, 90% of the businesses make a good net profit. So 2.0 or higher is what you're looking at. For management labor efficiency ratio, this looked at your overhead labor. So what your overhead labor here is, not your field labor. And anything 3.0 or greater, you are likely to make a good profit at the end of the year. So you can see here we're at 2.88. That just means that we have too much overhead salary for the size of business that we're doing, for the forecast sales that we're doing. So we have to do one of two things. You can see that we still have a net profit. These are where these two numbers work in tandem. we're making good profit still because we're at 2.5. That's quite a bit higher than the 2.0 that he states. So we're really efficient with our direct labor efficiency, but we're slightly under efficient on our overhead expense labor. So once again, we can do one of two things to improve this. We can say, you know what, we're going to do a bit more with our sales goal. Once again, how are you going to justify that? How are you going to get there? What's your plan to get there? Has to be reasonable. And all of a sudden, if I've decided that this is reasonable, based on maybe increasing my COGS materials, we're going to do a bit more in materials. Maybe I underestimated that and so on there. Or maybe we're going to add field labor because I didn't add them first and I knew we were going to hire them this year. Now we've hired them. I can plop them in here. We're going to be more efficient now. We're going to get more work done. Got to justify this number. Look at last year. What are you doing this year to improve efficiency, adding labor and so on and so forth there. But that's how now all of a sudden we're above that 3.0 mark. Another thing that you can do here is, okay, we're at 2.7. I think we're ready to hire another employee because we're really efficient. We're above that 2.0 mark. We're making net profit at almost 15%. I think it's time to add that next employee. We're going to pay them $20 an hour to start. I'm going to drag down this. And I'm going to drag down this. So yeah, I plan to hire that next employee. Look at that. We're still at our 2.05 mark. This helps you set what Greg Crabtree calls a salary cap in your business. If you guys are familiar with sports, hockey, NHL, I think other sports have salary caps. I don't know. I'm not sure. But hockey does. And hockey has a salary cap. You can't spend over the cap. This helps you understand what you can spend to in your business. 2.05, we're still efficient with our labor. I can afford to pay somebody $20 an hour. Can I afford to pay them $25 an hour? Well, let's go back. 1.93. Not quite. One thing we can do is we can maybe bump up our sales goal a little bit more, but is that smart? We've already bumped it up twice. This is where you start to like play with your numbers and get to see like, am I ready for that next employee? What can I pay that next employee? You can see here we added that next employee, our net profit went down, and our management labor efficiency ratio went down. All of a sudden, it's not looking too good to have a part-time admin on staff. Maybe I budgeted for this. I was planning to have them, but maybe it's not time. Now we're up to 4.25. As the owner, I'm going to have to take on all the tasks still. I'm not taking anything off my plate, but maybe it's more important for me to have somebody in the field producing more labor. So this is where it kind of, in my opinion, this gets fun. Take it for what you will if you're not into this as much, but I enjoy this and I like to kind of see where my business falls and whether I'm ready for that next overhead position there.
We want to take a break from today's episode to thank our sponsor, Knowledge Tree Consulting. They are efficiency consultants in the industry with 35 plus years of industry experience building Oriole landscaping in Toronto, which they are completely hands off at this point. George and Peter have been on the podcast before, and George, on multiple occasions now, I've personally leaned on him to help with the How to Hardscape headquarters software and how we can maximize the efficiency of user experience. And I know the guys at DTE Landscaping, Chuck and Jeffrey, who we've also had on the show multiple times, have hired them on in the past. Check out their consulting services, peer groups, and events that are coming up on their website, knowledgetreeconsulting.com, or check them out on Instagram at joinktc. Now back to our episode.
Overhead recovery. Okay, so cost of goods need to be, when you're quoting a project, you need to add the employees to that project. You need to add the materials to that project. You need to add the equipment to that project. You need to add the subcontractors to the project. You don't have to add overhead. Overhead is calculated in our overhead recovery. So we've got 4 different options here at the bottom. We've got multiple overhead recovery. We've got single overhead recovery, dual overhead recovery, and labor rate recovery. I'm going to start over here at labor rate recovery, and we're going to work my way to the right. Labor rate recovery dictates that labor is our most consistent and important thing in our business. So all of our overhead is going to be recovered by our labor. We mark up our labor to recover our overhead. I've talked about this a little bit throughout this, why I like it, especially for my business, where I don't know how much work I'm going to do for different types of work that I do, if that makes sense. But if I had a crew for design build specifically, and I had a crew for lift and relay specifically, and they never mixed, I could create 2 separate divisions and 2 separate divisional budgets And I might use a different overhead recovery rate for each of those. Just depends. But right now, while they're mixed, I'm going to use the labor rate recovery because it's consistent. It's on every single project. For me, equipment's not going to be on every single project, and I don't know the percentages of equipment that are going to be on different projects because I don't know how much lift and relay or how much design build work I'm going to do throughout the year. Same thing with subcontractors and materials. Labor rate recovery does not require you to budget for materials, subcontractors. You do, if you have cost of goods equipment, you'll have to assign those to projects, but the cost of goods equipment don't recover any overhead with it. That's the only difference. So labor rate recovery, you can recover by crews or you can recover by employees. I always tell our software users, if you're recovering by crews, it's good for 1, 2 crew companies. This is if like your crews are what's most consistent in your business. Is it crews or is it employees? If you have 1 crew, perfect, recovered by crew. If you have 2 crews and you have 2 employees on each crew, and you know you're going to have 2 employees on each crew, that's consistent. That's perfect. If you have 2 crews, you have 3 employees on 1 crew, 2 employees on another crew. That's inconsistent. It's better to price by employees. All this does is it just divides your overhead amongst either crews or employees. So labor employees, they're gonna get 33.33% of overhead each to recover throughout the year. 2 crews, they're gonna get 50% overhead each throughout the year to recover. That's all that's doing. And then we get, so if employees are selected, your total overhead costs, total labor hours, and your overhead recovery rate per employee, and your average hourly rate per employee. This factors in your overhead recovery. So like what you're paying your employee, your overhead recovery, and profit. And that's net profit. So this is where this is going to change things. Once you dial this in, you can then come to whatever overhead recovery you're going to use. So now 71.13 is what my average hourly rate per employee is. By crews is going to give me an overhead hourly rate or overhead recovery rate per crew per hour, 37.44, and my hourly rate per crew. And then you get a bit more of a breakdown for employees. You can see that I added that employee there, so I need to drag these down. They're yellow, so they are formulas. And so now I see, okay, what I'm paying my employee, so their wages, their rate per hour. So rate is not cost. Cost is what it costs you. Rate is what you would charge out. So this includes, like I said, overhead recovery and profit with what you have to pay them. So they 60.67 and 546.04 for the day. So this really starts to sink in of how much a day is going to cost you in terms of labor, overhead, and profit for each employee. And it really starts to sink in once you've gone 2 days over on a project, how much missed opportunity there is there. Now, every overhead recovery is going to have different rates per employee and a different average hourly rate. We'll talk about that. You'll also see that we get equipment, your cost per hour, your rate per hour, your rate per day. Labor rate is going to have the lowest rate per hour because we don't mark up our equipment to recover overhead. This is simply adding net profit to our equipment. So 4.55 becomes 5.07 just based on our net profit. No overhead recovery on equipment with this. Dual overhead recovery. Dual overhead recovery assumes labor and equipment require the same amount of overhead to manage, to make sure that they're efficient, to make sure that they're working, and so on and so forth. So we're going to group them together and we're going to give them a percentage markup to recover overhead. Materials and subcontractors require the less amount of overhead to manage, to get to the job site, to do and so forth, so on and so forth. So you're getting materials delivered. You don't have to, logistically get that figured out so much. Subcontractors, that you don't have to hold their hands so much. You just have to add a little bit of a markup to recover whatever costs you had involved and time involved in dealing with them. So this is where blue is what you can edit. So you can say you know what, materials subcontractors, 15%, that's going to change our markup on labor and equipment to a higher percentage because I lowered my percentage here. All it's doing is whatever we want to apply to materials and subcontractors, the remainder gets applied to our labor and equipment. And this is going to change our rate per hours and our rate per days, which I'll drag down here, and our average hourly rate per employee. So you can see here that our average hourly rate per employee is 63.19, but for labor rate, it's 71.13. Once again, that's because we have now a markup on materials and subcontractors to recover overhead, and the remainder goes on labor and equipment. So now we have not just labor recovering overhead, but we have labor, equipment, subcontractors, and materials recovering overhead. So that's why. You'll also get different rates per hours for employees compared to labor rate recovery, and you'll also get different rates per hours and rates per days for equipment. And once we go through single overhead, multiple overhead recovery, you can really dive into see which one is best for your business, not only methodology speaking, but also based on, you know what, are you comfortable with having 100% of your overhead recovered through labor? That really requires you to have it dialed in on what a project is going to take, how long a project is going to take you for per hour, right? You want to really have your production dialed in to know that and measure it throughout the year, to make sure you're hitting your hours on every single project. Downside to, or upside to that is the only thing you have to measure is labor. You don't have to measure, am I hitting my material sales goals? Am I hitting my subcontractor sales goals? Am I hitting my equipment utilization rate and so on and so forth there. This is where labor rate recovery is very simple. Dual overhead recovery, you're adding a little bit another layer of complexity. Single overhead recovery, I wouldn't recommend to anybody. It's here just so it's here. It just applies a overhead recovery rate to everything, and it's just one rate. So 33.23% gets marked up to labor, equipment, materials, subcontractors. All four of those categories get 33.23% markup. Once again, you can see the average hourly rate per employee, 57.73. You can compare that to each of these. Why is it lower than the dual overhead recovery system? Well, we have a different markup for our labor versus because of what we spread out our materials and subcontractors for. So single overhead, everything gets 33.23. Everything gets the same amount. Dual overhead, we're getting a higher markup on labor because we have a different markup on our materials and subcontractors. If I was to increase this, I get closer to our markup, a little bit closer, 29%, a little bit higher, 27. We're close, 36, yeah, whatever. 57.73, we're closer to that. So the closer I get this percentage markup to this percentage markup, we'd be at the same average hourly rate per employee. Last one, and to be honest, for everything, I would say like I would either be labor rate or multiple overhead recovery. And third, maybe dual overhead recovery. And then I wouldn't use single overhead recovery. It's just there for you. But that's kind of my list of priorities there. Multiple overhead recovery assumes that labor has the highest percentage of overhead or should get the highest percentage of overhead markup because it comes with the highest overhead costs to manage. Everything else gets a lower scale. So equipment, I think yours should be 25, 15, 10 or something like that. Those are kind of like starting points to mark up. This is good because you get to change your overhead recovery for these three because the equipment requires a little bit more than materials in terms of overhead expenses to manage, to repair, downtime, things like this. Materials less and subcontractors even less. This is the good thing about multiple overhead recovery. You get to mark up these very differently based on what you think that ratio should be. This is a good starting point, 25, 15, 10, and then you can adjust from there. Multiple overhead recovery is good because it diversifies where you're recovering your overhead. So if you're off on labor hours, maybe your materials might save you a little bit. If you're off on materials, well, your labor's marked up the highest, so that should save you a little bit as long as you maybe come a little bit below those hours. That being said, you can look at the average hourly rate per employee for multiple overhead, 64.07, compared to the 71.13 from labor rate. that's a $7 difference. It's not a whole lot. $7 per employee per day you go over a project on what you estimated. So you went over by 1 day. $7 times we've got 3 employees, that's 21. We work 10 hours. That's $210 a day. Not a huge amount if you're missing out on your hours. Is the materials markup of 15% on that project going to save you? Maybe, maybe not. But at least you're diversified a bit. Having said that, I do use a hybrid labor rate recovery method. I recover all of my overhead through labor. I still mark up my materials. My markup on materials are the difference between retail and contractor pricing. I charge my clients retail. I justify that because my clients, if they went out and bought materials, they'd be buying retail. I've got a good relationship with my supplier. I get contractor pricing. I charge retail. That's my markup on materials. So that's how I diversify a little bit. You can also add a markup on materials for if you do plants. Plants have a higher rate of warranty issues than pavers, perhaps. So maybe you want to mark up your plants a little bit more to recover warranty issues. Paver slabs have a higher percentage of warranty issues than 4x8 pavers. Maybe you want to mark up your slabs just a little bit more to cover you for those warranty issues. That's kind of getting into the weeds of things and not super important, but thought process there. And then finally, the last thing I'll leave you with, I'm sorry I went half an hour over everyone, but hopefully this was helpful in some way. And any questions, I can stay for whatever time you guys want to kind of go over things. This spreadsheet just tells you what you need to be billing for everything. And if you look at this and you're like, this is way too high for my market. Well, this is just based on what you've budgeted for in your business. These are things that are coming out of your pocket, whether you want to charge for them or not. It's at the end of the day, these aren't made up numbers. Hopefully there was some thought put into them to be able to come across like what you actually need to charge for employees and for your equipment to recover your costs. Remember, rate per day, rate per hour, rate per day, these include your markup to recover overhead and profit. So what if my average hourly rate per employee is too much for my market? What do I do? If you believe this to be the case, reduce your forecasted sales. This will negatively affect your profit. So one thing you can do is we're at 64.07. If I come down to 500,000, we're at 61.02. Our average hourly rate has decreased there. But also as your net profit has also decreased. Add field labor hours. Can you reduce, you can add hours to the season. So maybe last year was a fluke and you carried over last year's numbers and you're usually at 38 hours. There are 38 weeks per year. Maybe you can increase that a little bit. You're increasing your total working hours then and your total production hours per year. So maybe you can play with that a little bit, maybe see where you were at in previous years. Maybe you can extend your season a little bit by working into the winter a little bit more by setting up tarps and saving projects that can be done like that under tarps till the end of the year. Can you increase efficiency? So can you reduce the amount of unbillable hours? Audit your general expenses. Is there anything that can be strategically decreased or eliminated altogether? So overhead, general expenses, anything that can be gone, axed, decreased. But why? Is it actually doing something or is it just to get this number down that you want down, your average hourly rate? Audit your overhead equipment. Is there anything that can be sold? Things that have just been sitting around, sell them, rent them when you need them, get a little cash flow from what you sold it for, and use it in something that's actually going to be used and actually going to be producing you revenue and going to be making its money back for it. And then finally, improve your sales process. I've talked about it. If you listen to the How to Hardscape podcast, I talk about how I've improved my sales process and what I've done to do that. But audit your sales process. That's going to be the biggest thing. What can you do to add more value to your client, to everything, to help you close more deals? If your closing rate is low and you can increase that, you all of a sudden don't need as many leads, so you don't have to spend so much on advertising. If your closing rate is too high, though, that might be an indicator that your price is too low. So if you're closing 90% of projects, either people love you, you're the only one in your market, or your price is just too low, and people love that.
Thank you for listening to today's podcast episode. Check out the events on the events page at howtohardscape.com/events, or click the link in the show notes to see anything that we got coming up. And if you want to get in on today's, just send me a message at howtohardscape on Instagram. Send me an email, contact@howtohardscape.com, or click the link in the show notes. That'll take you right to the events page to sign up. And before we leave you, we want to say thank you to our sponsors. Cycle CPA. If you're looking for bookkeeping, accounting, CFO services, reach out to Cycle CPA at cyclecpa.com. Let them know How to Hardscape sent you for money off their services there. And Knowledge Tree Consulting. George and Peter there are efficiency consultants in our industry, and I've had the privilege of having them both on one episode of the How to Hardscape podcast, and George multiple other times. Always great episodes, and I also got to sit down on a one-on-one with George and went through what they do for businesses, and I left that meeting with a lot of value, so I can't recommend them enough. If you want to learn more about what they do, go to knowledgetreeconsulting.com and get that conversation started with them today. And we look forward to meeting you next week on the How to Hardscape podcast.